Hi everyone, in this video we will be going over A-Level Accounting 2023 February-March paper 2 question number 4. This is the structured paper 2 which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks, and we are given a total time limit of 1 hour and 45 minutes. Since question number 4 is of 30 marks, ideally we should be spending about 35 minutes in order to complete this question, and in this video as well we will be attempting to solve this question under 35 minutes. And I'll also be linking the question paper as well as the mark scheme in the description box. So without any further delay, let's get started. G Limited manufactures a single product type at one of its factories, and the company uses marginal costing. Now for the first part, we need to define each of the following terms. The first one is contribution per unit. So the contribution per unit is basically the difference between the selling price per unit and the variable cost per unit. Let's write it down. Contribution per unit is the difference between the selling price per unit and the variable costs per unit. The second one is stepped costs. So stepped costs are the fixed costs which change at a certain level of activity. So stepped costs are fixed costs which change at a certain level of activity. Now the third one is margin of safety, and margin of safety is just the difference between our actual or the forecast output and the break-even level of output. Let's write it down. Margin of safety is the difference between actual or forecast output and the break-even level of output. This concludes the first part. Let's move to the second one. We now need to say 2 benefits of using marginal costing. So the very first benefit is that it is useful for short-term decision making. And the second one is that it definitely avoids the arbitrary apportionment of fixed costs as we used to do in case of absorption costing. So it avoids the arbitrary apportionment of fixed costs. This concludes the second part. Let's move to the third one. We're given additional information. The following budgeted information is available for September 2022. Okay, we're given the direct price per unit, direct materials per unit. So we require 8 kgs at 2.70 per kg. So the price per unit is just going to be 8 times 2.70, which results in 21.6. Then the direct labor per unit, we require 4 hours at 8.20 per hour. So that's going to be a total of 4 times 8.20 per unit, which results in 32.8. And we're also given the fixed cost per month. All right, that's 18,400, and all units produced are sold. We now need to calculate the monthly break-even point in units. So the formula for break-even point is our fixed cost divided by contribution per unit. Okay, we can see that our total fixed cost is 18,400. And the contribution per unit, as we just wrote down in our definition, is the selling price minus variable cost. And the selling price in this case is 59. Our variable cost is direct material, 21.6. And our direct labor per unit, which is 32.8. Which results in the contribution per unit to be 4.6. This results in 4,000 units. That's our monthly break-even point. Now we're again given additional information. The directors hope to increase demand by improving the product, and the following information is available. So the current production of the original product is 7,200 units per month, and this represents 90% of normal capacity. So the normal capacity times 90% is given to be 7,200, which means that our normal capacity will be 7,200 divided by 90%, which results in 8,000 units. So our total normal capacity is 8,000 units. Now the direct materials will cost 3 per kg for the improved product, and each unit of the improved product will require 15% more material. So if we take a look above, we can see that each unit required 8 kgs. Now this kgs is going to be increased by 15%. So the direct material kgs per unit, previously we had 8, now we need to increase it by 15%, so that's 1 plus 15%, which results in 9.2 kg. So let's figure out the direct material per unit as well. That's the number of kgs per unit, which is 9.2, times our rate per kg, which is given to be 3. And this results in 27.6. Then the selling price of the improved product will be 65. That's our selling price per unit. It is expected that monthly production will increase by 20%. So we can see that the current production is 7,200 units. Now we need to increase it by 20%. So new level of units is just going to be 7,200. We're going to increase it, so that's times 1 plus 20%, which results in 8,640 units. Okay. Now, it might be quite tricky, but it's easy once you understand it. We can see that our normal capacity is 8,000 units, which means that for 8,000 units out of the total production, we can utilize the basic rate for our direct labor. But for the additional 640 units, we need to provide the direct labor at an overtime rate, or we need to provide a premium, which might be given right here as well. The factory can operate in overtime conditions, and the direct labor is paid 1.5 times the normal rate. So we have the normal rate, which we calculated above, to be 32.8 per unit. So that's the direct labor rate to be applied to the 8,000 units, which falls under our normal capacity. Now for the additional 640 units, we'll be providing 1.5 times the normal rate. So that's 1.5 times our normal rate of 32.8. This results in the direct labor rate to be 49.2, but this is only to be applied to the 640 units. Now an additional machine costing 40,000 will be required, and non-current assets are depreciated by 15% per annum. Okay, let's have a look at our question. We need to prepare marginal costing statement to show the monthly forecast profit, which means that we only need to figure out our depreciation charge for the month. First of all, let's figure out the depreciation for an entire year. That is just going to be the cost, 40,000, times the rate of depreciation, which is 15%, which results in 6,000. But this is the depreciation for 12 months. Now, we only require depreciation per month. That's going to be 6,000 divided by 12, which results in 500. And this will now act as our additional fixed cost. So previously, we had the total fixed cost of 18,400. Now we also need to add this 500. This results in the total fixed cost to be 18,900. Okay, so we have already adjusted all of our information. Now we just need to figure out the marginal costing statement to show the monthly forecast profit if the improved product is made. Okay, so this is for the G Limited, and we're preparing marginal costing statement. Which is for the improved product. All right. So it's easier if we start with our contribution per unit. But remember, we'll have two different contributions. So we have 8,000 units, which uses the basic rate of direct labor, and we have the 640 units, which uses the overtime rate for direct labor. Now let's figure out the contribution per unit for each of these level of units. The selling price is going to remain the same for both of these. So that's 65. The direct material will also remain the same, and we have figured out our new direct material per unit to be 27.6. But the direct labor for 8,000 units is 32.8. whereas for 640 units, it's 49.2. So the contribution per unit for 8,000 units will be 65 minus 27.6 minus 32.8, which results in 4.6. And for the new units, or 640 units, that's 65 minus 27.6 minus 49.2. But this results in a negative contribution, so that's minus 11.8. Okay, now let's start with the total contribution. We have two different contributions for this. For the 8,000 units, we have the contribution per unit of 4.6, whereas for 640 units, we have the contribution per unit of negative 11.8. So this results in our total contribution to have the amount of 29,248. Now, according to our marginal costing statement, we should just subtract our fixed cost after the contribution. So that's minus fixed cost, which we have already figured it out to be 18,900. Now this will result in our profit for the month. That's 29,248 minus 18,900, which results in 10,348. This concludes the fourth part. Let's move towards the fifth one. We have our additional information. At a second factory, the company manufactures another single product type, and the following information is available. Okay, we're given the direct material per unit, direct labor per unit, other variable cost per unit, as well as the selling price per unit, and the fixed cost per week. Now, the factory uses 10 machines, each producing 300 units per week. So one machine produces 300 units, and we have a total of 10 machines. So 10 machines will produce 3,000 units. And this will be per week. Now, the directors are aware that the problems have arisen with 4 machines which require urgent repairs. Those machines will be taken out of production for 8 weeks. So if we are taking out 4 machines, we'll now only have 6 machines. And for 6 machines, we can get 300 times 6, which is 1,800 units. This is per week, but we're talking about 8 weeks. So let's figure out for 8 weeks. 6 machines can provide 1,800. This is per week. So if we just multiply it by 8, we get the total production for 8 weeks. That's 14,400 units. And if we had 10 machines, it would have been 3,000 times 8, which is the total of 24,000 units. Okay. So we ideally have 24,000 units for 8 weeks, but since we have taken 4 machines for repairs, we'll only have 14,400 units. So the directors are considering 2 options. Let's have a look at our question first. We just need to calculate profit for the 8 weeks for each option. Okay, let's focus on option A. We will buy in goods. So we can only produce 14,400, which means that whatever lost production there is, let's figure it out. That's 24,000 minus 14,400, which results in 9,600. So we'll buy in this lost production, and the goods will be provided by an overseas supplier at 34 per unit. Then the total delivery cost of 4,200 for 8 weeks will be charged. So this will now act as our fixed cost. Let's figure out the fixed cost for option A. We have the fixed cost per week of 12,000 previously, so that's still going to be 12,000, but since we're talking about 8 weeks, we need to multiply it by 8 and then add the 4,200 for the 8 weeks. This results in the total fixed cost for 8 weeks to be 100,200. Alright, then the supplier can only provide 75% of the lost production. So we have the total lost production of 9,600, but the supplier will only be able to provide 75% of this, which is 7,200 units. So what this means is that we'll buy 7,200 units at the rate of 34 per unit, whereas we'll produce 14,400 units at this rate. So let's figure out our contribution per unit based on the given information. We'll start with our selling price, that's 42, minus direct material of 13, minus direct labor of 11, and minus other variable costs, so that's minus 3. Now, based on this information, our contribution per unit will be 15. So this is the contribution per unit for the 14,400 units, right? Now, we need to figure out the similar contribution per unit, but for 7,200 units. Remember that contribution per unit is basically subtracting our cost associated with that product from the selling price. And in this case, the selling price is going to remain constant at 42, but the cost of this is 34 per unit because we're buying it, right? So that's minus 34. This results in the new contribution per unit to be 8. So we will apply this contribution per unit for 7,200 units and this contribution per unit for 14,400 units. So let's prepare a statement in order to figure out the profit. We'll first start with total contribution. Okay, we have 15 contribution per unit for 14,400 units. So 14,400 times 15. Then we also have 7,200 units which we'll buy in, and the contribution associated with it is $8. This results in the total contribution to be 273,600. Now the next step is to subtract all of our fixed costs, and we already figured it out to be 100,200. So the second option is to hire replacement machines, and only 2 replacement machines are available at a cost of 150 per machine per week. Then the machines will only be available for 7 weeks. Okay, let's figure out our additional units. We are already told that each machine can produce 300 units per week, and we have 2 different machines. So that's 2 times 300. This will be our production per week, but we are told that the machine will be available for 7 weeks. So we just multiply it by 7. This gives our additional units to be 4,200. And staff will require training on the replacement machines at a total cost of 700. So let's figure out our fixed cost now. We start with the previous cost of 12,000 per week. And since we're trying to figure out the profit for 8 weeks, we also require the fixed cost for 8 weeks. Then we have the hiring cost. So we are hiring 2 replacement machines and the rate is 150 per machine. So that's times 150 and it's per week, but we are hiring it for 7 weeks. So we just need to multiply it by 7. And then we also have the additional costs of training, which is of 700. So that's plus 700. This results in our total fixed cost to be 98,800. Okay, in this case, we don't have 2 different contributions because we are producing all of our units on our own, but we're only using the replacement machine instead of our own machines. So we have the total units. The new one from the replacement machine is 4,200. We have the capacity to produce 14,400 units. That results in the total units of 18,600. And we'll still be utilizing the contribution per unit of 15. So let's figure out the total contribution. We figured out that the total number of units is 18,600 and the rate per unit is 15. Which results in our total contribution to be 279,000. Now the next step would be to subtract the fixed costs. Let's have a look above. We already calculated it to be 98,800. Now we can get our profit for 8 weeks. That's going to be 279,000 minus 98,800, which results in 180,200. Okay. Now let's move towards the 6th part. We now need to advise the directors which option they should choose by justifying our answer by considering both options. Okay, let's talk about option A. Let's compare the profit between the 2 options. So for option B, we have 180,200 and for option A, that's 173,400. So this definitely means that it produces a lower profit. And for option A, we are purchasing the goods from an overseas supplier, right? So we can question the reliability of the overseas supplier. Then we can also question the quality of the goods that will be bought in. Will quality be maintained? For goods bought in. And there is also the risk of losing customers if the quality from an overseas supplier is not acceptable. Let's write it down. Risk of losing customers if the quality is not acceptable. Now let's talk about option B. We've already figured out that it produces a higher profit. And since we are hiring new replacement machines, we can question the efficiency of it, right? Will the efficiency suffer due to working on new machines? Let's write it down. Will efficiency suffer due to working on new machines? And we had the total loss production of 9,600, but the additional production is only 4,200. So this just means that regular customers may not be supplied, due to which they might go to competitors. Let's write it down. Regular customers might not be supplied, and due to this reason they might go to competitors. Now, based on these factors, we need to advise the directors which option they should choose. Based on profitability, option B is suitable. Also, we will have all of our quality of the goods under our control. So it's suitable to choose option B in my opinion. So I'm just going to write that decision down clearly. The directors should choose option B. Alright, this concludes question number 4 of 2023 Feb-March paper 2-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you are subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.